As we get ready to say goodbye to March, we have a slightly more low-key week ahead of us, although there should still be plenty to keep us interested. On the macro front, watch out for UK mortgage application data for February on Thursday the 29th. As we can see here, this figure bounced back to just over 67,000 in January after a fairly soft December. These figures will be of particular interest to the house building stocks and all firms related to the building trade, especially as the headline figure has now dropped year on year for 4 straight months. Also watch for the latest GfK UK consumer confidence number due on Friday the 30th. The reading ebbed again to -10 in February, so let's see how it looks for March with retail stocks in mind in particular. As we can see here, it's possible to argue that consumer confidence is a big driver for the FTSE all-share general retailer sector, where heavyweight names include Next and Marks & Spencer, even if, as we all know, correlation does not mean causation. In terms of corporate news flow, we've a handful of FTSE 100 firms and a good smattering of FTSE 250 stocks scheduled to release earnings numbers or trading updates. They include cruise ship operator Carnival, bookmaker and bid target Ladbrokes Coral, and utility Pennon on Monday the 26th of March, United Utilities on the 27th, and acquisitive plastics packaging group RPC on the 29th, which is also the deadline for shareholders to decide whether to accept Melrose's £8 billion cash and shares offer for GKN, or not, as the case may be. The GKN Melrose story remains absolutely gripping, but I suspect that the company capable of generating every bit as much interest when it reports first half results on Tuesday the 27th is plumbing and heating equipment distributor Ferguson, which used to be known as Wolsey. The company renamed itself because the US operation, Ferguson, represents the vast bulk of the company, especially now the Nordic business, Stark, has been sold. The company now reports in US dollars for good measure. As you might expect, given this American exposure, Ferguson shares welcomed President Trump's cut to US corporation taxes in late 2017. In January, the company noted its tax charge for the fiscal year to July 2018 would see the charge drop to around 25% rather than the guided 28%, and then run at 21 to 22% going forward. However, the shares have retreated since the publication of this news, and there may be 2 factors at work here. The first is the dollar, which has weakened. That will reduce the value of Ferguson's earnings in the US once they're translated back into pounds. That's just maths. The second, well, that's the US housing market. As we can see here, the year-on-year growth rates in new building permits, new housing starts and new housing sales have just lost a little bit of momentum, although the monthly numbers do move around an awful lot. Now, this possible slowdown in housing may not be the biggest surprise after a series of US Federal Reserve interest rate increases that began in December 2015. And that policy shift has seen the 30-year fixed-rate mortgage average in the USA rise to its highest level since January 2014 at around 4.4%. So, when it comes to the interims, analysts are looking at 4 things from Ferguson. First, organic sales growth. At group level, this was 7.6% in the first quarter, with the US up 8.3%, the UK up 3.2%, and the other international businesses up 7.7%. Second thing to watch for will be profits. Analysts are looking for around 6% growth in earnings per share for the year, so that seems like a fair benchmark for the first half. Third, the dividend. For the full year, the consensus analyst forecast is for an increase from $1.37 to $1.75 a share. And finally, the balance sheet. Ferguson ended the first quarter with $790 million of net debt. The Nordic disposal would have pretty much wiped that out, although the company did launch a share buyback program in September. Thank you for watching, and I look forward to seeing you next time.